Welcome back. In the last episode, we talked about how Blue Owl Capital, the Beyond Blue Owl, saw its stock halved because of a bead redemption gate incident and became the canary of the US stock market. Today, we are going deep into the bones of this company to see how its business model really works and why its pain foreshadows a larger disaster to make it easier to understand. We first need to clarify a term Blue Owl loves to use: permanent capital. Sounds wonderful, right? Permanent means the money is mine forever, no need to return it. Traditional hedge funds or private equity funds usually have a term, say 7 or 10 years, after which they must return capital to investors, or if it's in an open-end fund, investors can redeem any time. That is a nightmare for fund managers, because when markets turn bad and everyone rushes to redeem, the manager is forced to sell assets at the bottom, amplifying losses. Blue Owl solved this brilliantly through a structure called Business Development Company. BDC. A BDC is like a publicly traded investment fund that raises money by issuing shares to the public and then lends that money to companies. For Blue Owl, once the money is raised, in principle it stays in the pool forever. Investors who want to exit can only sell their shares in the secondary market. They cannot ask Blue Owl for their money back. Sounds like a perfect business, right? Blue Owl gets permanent money, collects management fees every year, and if performance is good, also takes carried interest. That's why Wall Street chased the old LL stock so hard in recent years. Its revenue looked like collecting rent, guaranteed regardless of drought or flood. But the devil is in the detail. This model has a fatal flaw: the conflict between valuation, illusion, and liquidity mismatch. The OMADC2 we mentioned in the first episode is exactly where this contradiction explobubeats2 is an unlisted DDC, although it doesn't trade publicly. To attract investors, Blue Owl usually promised limited, allowing redemption of up to 5% of total assets each quarter. This created the illusion for investors that the investment offered bond-like high yield with demand deposit like FlexL. However, when the macroeconomic cold wind started blowing in the second half of 2025, especially the 43-day government shutdown in October that broke cash flows for many companies reliant on government contracts or regulatory approvals. If you were an OBNDC2 investor, what would you think? You'd see news that borrowers might not be able to repay Blue Owl Drew All B loans. You'd see the listed OBNDC trading 20% below NAV. Your instinct run, redeem me. When everyone tried to redeem their 5% in the same quarter, a bank run occurred. Blue Owl discovered it simply did have enough cash to meet redemption requests. It also could instantly call back the loans, many of which were 5-year or 7-year term loan. So Blue Owl made the market-shocking decision: suspend redempts. This wasn't just breaking a promise, it was broadcasting to the world: my liquidity is exhausted. Let you dig deeper. Why is the market discounting the listed OBNDC by 20%? Why does not anyone believe Blue Owl their own NAV quality? This touches the core risk of private credit: opacity of asset quality. In public markets, if a company has problems, financial statements show it. Analysts downgrade. Stock falls. In private credit, borrowers are private companies with no disclosure requirement. Blue Owl says a loan is worth $100. You have to take their word for it, but the market isn't stupid. Through other clues, the market discovered borrowers are struggling badly. A key indicator is the proportion of bum payment in kind. PIK and interest in simple terms. PIK means the borrower can't pay cash interest, so they say, I owe this month in interest. I'll give you an IOU and draw it into principal. Pay later with interest on interest. For the lender, Blue Owl, this still counts as full income on the books, still earns management fees on it. On paper, performance looks fine, even better because principal increased. But in reality, it is a sign the borrower is out of cash. It'd be like lending money to a friend who pays interest with more IOS, and you treat those IOS as income to go. Shottom data shows that in 2025, the proportion of VK income rose significantly across Blue Owl and the entire BDC industry. More and more zombie companies are surviving by issuing IOS. This is a time bomb buried in Blue Owl Jin balance sheet. When Blue Owl tried to merge the unlisted OBT2 into the listed OBDC, it was trying to defuse the bomb by turning in dead money that wanted to leave into tradable shares. But this enraged existing listed shareholders who did want to pay for potential bad loans or faced massive selling pressure. Result, lose the merger was abandoned, stock crashed, credibility destroyed. Dear listeners, if you think this is just Blue Owl bad luck, you are too naive. Blue Owl is not only a direct lender, it also has the GP strategic capital business we mentioned investing in other private equity giants. That means Blue Owl is a metal leverage amplifier for the entire PE ecosystem. If Blue Owl catches a cold, the PE giants it invested in Vista, Toma, Bravo, etc. Their portfolio tech software companies may already have pneumonia. In 2025, with interest rates staying high, even though the Fed cut a little, borrowing costs remain expensive, plus the catastrophic government shutdown. The private equity industry is facing the worst seat drought in history. IPO market frozen, M&A dead because buyers have no money. P firms can't sell portfolio companies, can't pay dividends to Blue Owl. A river is drying up, so when we see Blue Owl struggling around $14, we are actually seeing the entire US credit system sending a net Svoris. It tells us the prosperity built on low rates. Refinancing and valuation games may really be N, but this Blue Owl is not the only bird screaming. If you look away from Wall Street toward the real economy, you would find other canaries. Shiver next episode would leave the office towers and look at trucks running on American highways and the cardboard boxes carrying goods, telling a completely different recession story after dissecting Blue Owl, the financial canary. Let you now turn to the real economy. If financial data can sometimes feel a bit fake due to accounting rules and valuation models, the indicators we talk about next are hard, tangible, even smelling of soy, we know. Any industrial boom must be confirmed by transportation. Simple logic. If factories produce mountains of goods, industrial index up, but no trucks, trains, or planes move them to consumers, transport index down, that boom is fake inventory buildup. At the end of 2025, we are witnessing this divergence reach a terrifying extreme. Look at the Dow Jones Transportation Average, DJT. While the Interpete 500 marched towards 6,800 under the AI halo of Gemini 3, the DJT was like a kite with its string cut. Pot in November, the transport index not only failed to follow the broader market, but fell nearly 8%, underperforming the broader market by more than 20 percentage points for the whole year. This is not just a numerical divergence, it is a sign that America's economic arteries are hardening. In this sector, there are two giant canaries, FedEx and UPS. They deliver billions of packages every day, tentacles reaching every corner of the globe. So they sense economic temperature more accurately and earlier than any economist in their 2025 Q3 earnings calls. Both giants issued severe warnings simultaneously. FedEx Xena report was a disaster. Revenue and profit both missed, and full-year guidance was slashed sharply. Continued industrial economy weakness continues to pressure our B2B volumes. Note: industrial economy. The problem is not just consumers buying fewer clothes. Business-to-business activity is shrinking. UPS is similar despite layoffs and network optimization. Volume decline is undeniable, but that not the most visual. To know how pessimistic retailers are about the future, we look at a very niche but extremely accurate indicator, the BA cardboard box indicator. Think about it. Almost every consumer good from toothpaste to iPhone, from Nike shoes to Amazon packages, needs a corrugated cardboard box. If boxes aren't moving, nothing is moving. According to the Fiber Box Association, U.S. corrugated box shipments in the third quarter of 2025 hit the lowest level since 2015, a suffocating data point. Remember, 2015 wasn't great either, but now itchy, supposedly a bull market. 2025 even more frightening. Giants like Payback Corp of America revealed that in the traditionally busiest pre-holiday months of September and October, orders were flat or even down. This means Walmart, Target, etc. have zero confidence in the coming Christmas season. They are desperately destocking rather than stocking up. They go rather have empty shelves than warehouses full of unsold goods. The in-strong consumer spending story we hear in the news and the story told by cardboard box data are two completely different versions. This is the Bainham paper box recession. It tells us physical goods circulation is frito in combined with the 43-day government shutdown in October. The supply chain impact is lagged. Many government contracts pause, import aid approvals halted, causing massive goods stuck in ports or warehouses. This premise cloud effects are gradually showing in transportation companies. Financials, moreover, the transport winter is spreading upstream. The trucking market in 2025 is called the continuation of the been a great freight recession. As spot rates remain depressed, many independent truckers forced out because they can cover fuel and insurance. Tricolor Ray bankruptcy is related. Many truckers are subprime borrowers. We'll cover that next episode, so when we look away from K-line charts toward highways and ports, we see depression. Trucks running empty, boxes piling up, delivery steps slowing. This artwork Canary is silently telling us, no matter how beautifully the RI story is told, if physical goods can be sold or moved, the economic engine will stall sooner or later. So if goods aren't selling, what happened to consumers? Where did their money go? Why are not they spending even though unemployment looks healthy? Next episode, with open American consumers, wallets, and look at shocking black holes in subprime auto loans and buy now pay later. See you next time.